If there was any doubt in your mind at all that the cards are stacked in different directions that are not in your favor, well, I'm pretty sure this video that I'm doing today is going to resolve that issue. But I'm going to start with this little thing that just came over the Bloomberg terminal, and I thought it was really interesting. SVB's loans to insiders tripled to $219 million before it failed. That includes, loans to officers, directors, and principals, shareholders, and their related interests more than tripled from the third quarter last year to the final 3 months of 2022, when they already had regulators in there that was flagging problems. And so when these banks fail and other banks absorb the good parts, and they leave the garbage over at the FDIC, which you and I are responsible for. Wait until you see what I found. You got to watch this whole video, probably at least twice or 3 times. It's critical that you understand this. Coming up. How many times can you be lied to when you do not know the truth? I am here to tell you, and not just tell you, I don't want you to take my word for anything. That's why I always give you the links so you can do your own due diligence and formulate your own opinions. But it ticks me off when people are lied to. So let's just jump in because this is probably going to be a reasonably long video. So how about this? We're just going to start right off the bat. Fed borrows $184 billion without congressional authorization, circumventing the debt ceiling. Isn't that interesting? In the past week, the Fed's financial statement shows it borrowed an additional $143 billion to fund the FDIC's bailout of Silicon Valley Bank and Signature Bank. $143 billion. The Fed borrowed these funds and lent them to the FDIC to keep these bank failures from reducing the Treasury's cash balances. How about they borrowed them and loaned them to the FDIC because the FDIC only has $128 billion in the DIF fund. So it may have some impact on the Treasury's cash balances because, of course, you know, we're at the debt ceiling and we haven't seen an approval to lift the debt ceiling. I'm sure we'll see that pretty quickly. But how about so that it was obvious or not obvious that the DIF fund, that garbage deposit insurance is exactly that, garbage. Fed borrowings do not count as U.S. Treasury debt and are not counted against the Congressional Treasury debt ceiling limit. I mean, come on. We are so naive. The Fed borrowed $143 billion from the U.S. Treasury to lend to the FDIC to bailouts. The DIF fund that's supposed to fund these bailouts only has $128 billion in there. So these two banks would have more than wiped out that DIF fund. So for anybody that tells you, but we're insured, it only works, this is counterparty risk. And any contract that has counterparty risk is only as good as the entity on the other side of that. So there you go. It gets better. Just wait until you hear. Being a potential banking crisis with a fully depleted insurance fund would not have instilled confidence in the administration's claim that the banking system is sound. You think? I mean, we heard the audio from the FDIC back in November saying that the public has a lot more confidence in the banks than they do. U.S. studies ways to guarantee all bank deposits if crisis expands. Authorities don't see expanding FDIC coverage as necessary. Well, actually, they are talking about expanding that now. And that's going around the world, too, where they're going to raise it. And you might recall that in 2008, it used to be 100,000. They raised it to 250 to stop runs on the bank. But what are they raising it to? What does it mean if they don't have the funding in there to begin with? What are they going to have to do? Well, this is what they're going to have to do again. But wait until you hear this little audio.
Up to you at some point, if you're talking about even hypothetically that unlimited deposit insurance, what catches up here? Who pays for it? It certainly can't fully be funded by the bank term funding program. So where does the money come from?
Well, the deposit insurance fund is funded differently from the special emergency lending facility that the Fed announced for banks. Basically, it's a special discount window facility. The FDIC is supposed to be funded with deposit insurance premiums that the banks pay, and it has a line of credit with the Treasury, and it could use the federal funding bank. It's interesting to note that actually this time the FDIC borrowed from the Fed, and I have a new piece out in the Hill just at noon today, which breaks that all down, which is kind of a very startling occurrence. The FDIC never borrowed from the Fed in the past. They always used the insurance fund to fund bailouts or to fund resolutions, and even last time they asked banks to pay FDIC insurance premiums ahead of time, advanced premiums to raise the money. So they didn't want to go into debt. It's interesting that the FDIC actually borrowed $143 billion. The Fed's recent financial statement shows to fund the two bank bailouts, which is more than the $128 billion in the FDIC Deposit Insurance Fund currently. So the comparison of those two numbers and only two banks going down isn't going to instill a lot of confidence in people once they realize putting those two facts together.
Paul, speaking of confidence, we heard you reference First Republic, and obviously last week we saw a sizable commitment by financial institutions to putting deposits to work with First Republic. Now there's some developing reporting, the Wall Street Journal talking about what JP Morgan's Jamie Dimon might be doing right now. In terms of deposits that might be committed, and then whether or not something turns into some form of capital to try to further provide stability to, let's say, a regional bank. What's your view on that?
This bailout is like shades of 1907 when J.P. Morgan, bailed out Wall Street and the bank run in 1907, organized it with other banks. It's very strange in modern times. According to the First Republic filings, SEC filings, they're getting paid market rates on this money, which is reportedly up to $30 billion from this consortium of banks. So that doesn't do their profitability going forward. It doesn't help them at all. It might stem the run. But again, it puts them in the same position where they're paying a whole lot more for their funding than they're earning on their assets. And it's a very unusual situation. I mean, it hasn't happened at all. Generally, a large bank comes in and bids on a bank, or they merge to get the bank out of trouble. But apparently that's not happening this time. And I guess the reports I read is J.P. Morgan's trying to broker some kind of deal for the bank. But this whole consortium of banks going together and putting in $30 billion, I'm sure they talk to the regulators first. And if there's no guarantee, there's some kind of nod and a wink that it's really going to be safe for them, I guess, because you just don't, put $30 million in a failing bank.
A lot to digest, for sure. Paul Kubiak, American Enterprise Institute Senior Fellow, we thank you as always for your time and your insight.
So there's a couple things in here. Number one, well, there's more than a couple, and I would re-listen to that again. But number one, what was happening in 1907? We were shifting into a brand new system that was taking real money, gold, out of the system and replacing it with garbage, right? This was designed to imitate and mimic this, and we've lost a whole lot of purchasing power since then, and given these central banks and governments a whole lot more power and control. And we are now at the end of this grand experiment. And if you think JP Morgan or all of those banks went in and deposited that 30 billion or whatever it is, number one, was that your deposit that they loaned to this First Republic Bank? But they did it to prevent a broader run, because they need you to stay calm. They need you to think nothing has changed, when in reality, everything has changed. And I'll tell you when it really changed was 2008, when the system actually died. And it was put on life support till they could get the next system in place. And if we don't come together and say no and vote with our purses, then we deserve what we end up getting. Because I could tell you my personal strategy when we got to the other side of this mess was to convert a lot of my gold into the new currency. You think I'm going to do that now that I know that the direction that they wanted to go in is CBDCs? No, I will not. I will do it as I need it. But why in the world would I put my wealth and my family's future in jeopardy? And why would you? Now, let me show you something. I mean, I've been inside the OCC quarterly report on derivatives in the banking system all the time. It's my go-to place. I don't know why I didn't see this before, but when I saw this time, I just about fell off the sofa. How big is this problem? Because what I'm going to show you is the core of the bomb, that really tightly compressed explosive that will easily overwhelm any central bank's or government's ability to do anything. And this is, oh, we missed it. Darn it. I didn't realize it wasn't in frame. It's too late. It's too late. But you know what? It was the Jenga set. And we are in a Jenga economy, make no mistake about it. Let me show you what I found that freaked me out. So, as I said, this is the most current one that they have. So even though they should have their fourth quarter numbers, maybe we'll get them in another week, I don't know. But this is the most current one that they have. And I've talked about how in 2013, they created these formulas to take the notional value of all of the derivatives and compress them, right? Make them look a whole lot smaller. So notional amounts of banks' derivative contracts have generally declined since 2013 because of trade compression efforts, leading to less need for risk management products. Woohoo! Saves the banks a lot of money on their speculative bets. And remember, they've already taken apart the Volcker rule. So, I mean, we already have the risk-taking banks merged with the deposit-taking banks. They've just eliminated the Volcker rule and renamed savings deposits as transaction deposits. I mean, they've gotten everything all set up for these banks. I mean, this is a club, and you and I aren't in it, and I don't want to be in it. Let's start our own club, right? Trade compression aggregates a large number of swap contracts with similar factors. Now, not the same factors, mind you, just similar factors. So I guess that could be subject to perception. This makes it appear like fewer contracts, and it hides the risks. This trade compression reduces capital costs for large banks because they don't need to buy those risk management products, and they don't need to hold as many reserves. And actually, they don't have to hold any reserves anymore. Remember? We already took care of that one too. Yeah, and all of this is supposed to make the system safer? I mean, please. For who? The banks that just got bailed out? Now, this is quarterly in trillions of dollars. And guess what that number is? So here's 2013 when they first started, and here is the third quarter of 2022. $180 trillion they spent in 1 quarter to compress a bunch of derivative trades and make the trades look smaller. 180 trillion. You see all those zeros? And all that really does is it hides the leverage and hides the risk. It's below the surface. So when we're talking about the iceberg, this is all the crap that's in the iceberg, but this iceberg is condensed and condensed and condensed. Let me show you. Because this is what a financial time bomb looks like. And this is the core. You've seen this before, notional amounts of derivative contracts that are held for trading. Now remember, the Volcker Rule wanted to eliminate proprietary trading. And that's what Glass-Steagall was about, was separating deposit-taking banks from risk-taking banks. So in all of the garbage that they've created to make you feel safe and lull you into a false sense of security, what they've really been doing is just hiding the risk from you and keeping you inside the system. You know, and it is really all about numbers. So if we look at what we've got here, 97.4% of all of their derivative contracts that they are admitting to is held for trading purposes. You think any of those are speculation? Or maybe you think all of those are for speculation. Okay? That is, now understand this. The banks are holding $21 trillion in assets, which includes about $17 trillion in deposits. Total derivative trading, $185.7 trillion. So let's think about this for a minute, okay? Because they spent $180 trillion to compress and make it look smaller so they don't have as many fees and they don't have to do this risk management. And they got that down to $185.7 trillion. I don't know about you, but something seems a little fishy to me. Isn't it interesting that basically they would spend as much to hide the trades as they are to the amount that they're admitting that they're trading? I know this is confusing, but can you see what I'm talking about here? Because banks generate a ton of their revenues from trading. This is trading revenue, okay? And look at, there's 2008. Banks lost money. Oh, we don't want that. We want banks to make money. We don't want them to lose money. They're too big to fail. And even the ones that we thought were not too big to fail, apparently are too big to fail. And what's going to happen with all those loans? Because if those are garbage loans, the FDIC will keep them. I'm telling you, this stuff drives me out of my mind. Now, the median is 44% of the trading revenues of all of the trading goes into the bank holding revenues. But, gosh, last quarter or second quarter, it was 100% of the bank's revenues. And even now, you are a much higher level than the average. So just like SVB, when they knew that they were in trouble, and we knew that they were in trouble. We knew it, right? What did SVB do? Loans to officers, directors, and principals, shareholders, and the related interests more than triple from the third quarter last year. If you get a credit card when you know you're going bankrupt, you're going to declare bankruptcy, what are you going to do? And they know this is the end. They don't talk about it like it's the end, but I'm telling you, because nobody knows what the true level of derivative trading is. You see how this is like consolidated and tightly mushed into this core of the bond. And the fuse has already been lit. And it always happens slowly until it happens fast. And the other part to think about, if they spent $180 trillion to reduce that, how much did they save by reducing that? I mean, I'm telling you right now, easily in the many quadrillions of dollars. Quadrillions, 180 trillion. And I've done quite a few videos on this compression. And so if anybody wants more information on that, Edgar, you're going to pull those up and you're going to have access to it. And I would really strongly suggest that you go back in and you look at them. And I'll take a minute this afternoon and I'll kind of highlight the most important ones for you to watch, because this is critical. This is critical. It blew my mind. 180 trillion to compress it down to 185.7 trillion. There must be many, many, many quadrillions. Nobody knows how much risk there is. The IMF, the BIS, the FDIC, the Treasury, the Fed, the World Bank, the World Economic Forum, every single entity admits that they really don't have any idea how big this is, because it's all hidden with fancy accounting footwork. Now, we've had 2 derivative explosions so far. We had the first one with long-term capital management in 1998. And this very similar thing that's happening right now with the banks rushing in to keep it hidden from us. That's what they did when long-term capital management exploded in 98. Wall Street and the big banks went in and bailed that puppy out, covered it over. Did you even know we had a derivative implosion in 98? Probably not. That's the goal. Keep this hidden so that you do not change behavior, so that you keep your money in the stock market, in the bond market, so these derivatives can play off of the price action above that. But there's another layer of problem in here, and I didn't put it in here, but I did talk about it recently, and that's with ION, which is a clearinghouse for derivatives that got hacked. And so all of this trading that's happening right now is basically happening blind, because they have not yet, the CME group that publishes that and sends out that report so that traders know what other traders are doing. They're not up to what day is today? March 21st? Okay, they're still back in February. Maybe this week they enter the first week of March. So these guys are flying blind. You should not feel safe about this. I do not feel safe about this at all. Nobody knows how much hidden risk is there. But let me tell you, once you know it, it's too late. Or once you see it, that's a better thing. Because the Glass-Steagall Act and the Volcker Rule with trying to stop that proprietary trading. These are the notional amounts of derivatives in the FDIC insured bank that just had to pay out $148 billion, because after all, they loaned so much of their wealth out just before this crisis. I mean, and you're going to claw it back? Maybe it's not there to be clawed back. What are you going to do? Right? So here you go. There's 2007, and the fuse was lit in 2007. Do you remember when Bear Stearns went in, was bought out by JP Morgan? It was really so that this would just keep the system calm. I'll do another piece on that here quickly. But the system would remain calm because, after all, now the issue is solved because JP Morgan bought them. But then when did you know that there was a crisis? Probably in September of 2008. Well, trading. So these are legacy trades before compression. And you can see how much they grew from 2000 to 2007. Nobody knows how much they are now. Here's when compression was created. So it just looks smaller. But these are all trading derivatives. 97.4% of their derivative portfolio is for trading. That means it's for speculation. Down here at the very bottom, non-trading derivatives. Yeah, that's end user. So what do you think? What do you think? You think this is safe? Do you think the diff fund is going to bail out your savings? Or hey, they'll just insure all of it. What does that really tell you? And we're about to get whether or not the Fed is going to raise rates by 1/4 of a point or not raise rates or lower rates. But guess what they've already done? I'm going to show you this in a minute. So it's all garbage that is specifically designed to keep you in a dying system that can fail any moment, any moment. I'm not up at the bug out location yet because the public doesn't really understand the danger yet. The notional value represents just the market value of the contracts, not what is really out there that can blow up. So can you kind of, what I'm really hoping is that you see how dangerous this is, even if you don't fully understand it. They spent, think about it for yourself. Would you pay $180 trillion to protect $185 trillion? That doesn't really make any sense unless the issue is much, much bigger and how much they have saved doing that. Everybody admits that they have no idea what the real value is at risk. But you need to be very, very clear that the banking crisis fuse is lit. When it's going to get to the core is anybody's guess. But it's lit, and it's not going away. And to attempt to put it into some level of perception. These are right here. This is assets versus derivatives in all FDIC insured bank. And these two little buildings here, tall buildings really, are the assets, 21 trillion. But all of this and ever so much more are just the reported derivatives. How much bigger is that? My God. These are different sports fields. This is the White House. This is a person, this itty bitty little dot right there. Can you see what the problem is? And just kind of let's look at it. 128 billion in the FDIC diff fund, and that's only because the Fed borrowed from the Treasury and loaned 148 billion to the FDIC so that they could make good on all of those depositors, insured and uninsured. What are you worried about? Because if they saw uninsured depositors get bailed in, then maybe you're starting to think, oh, gee, maybe I'm going to get bailed in. So that's why they're doing it. It's to keep you calm. That's why they're doing it. Because they need your wealth in the system. It's far, far, far easier to take it away from you. There's 17.6 trillion in deposits at commercial banks. A bunch of that is uninsured, but hey, didn't they just show us they'll just go in and backstop everybody? And who's really supposed to pay for that? Taxpayers. That okay with you? Not okay with me. The U.S. GDP, this is all the money that flows through the entire U.S. system, is only 25 trillion. You starting to see the problem? I hope so. What we're holding, the public debt that's held is 31 trillion, and we're at the debt ceiling. They're going to raise that. The system is dying. I hope you can see it and make choices that puts your best interest first. Because the public debt as a percent of the GDP is 120%. 120%. And that's only just the public debt. That's not all of the debt. That's just a little bit. Can you start to see the problem? So when people say, oh, that would never happen here, it's happening. It's happening. And by the way, Fed's already doing this. In fact, they're actually doing this. They say they're not doing it. Well, okay. Look at this. They have to do it because these banks are out of cash. Measure of cash suggests some institutions may have already reached scarcity. So the banking system is deflating. Large banks' cash equivalents as a percentage of assets, 9.5%. Small banks' cash equivalents, 6%. But don't worry, because they'll come out like they did in 2020 and say, you can withdraw as much money as you want because we'll just print more. But every time they do this, the value of what's already out there declines. So they can't fight inflation by raising rates and causing deflation if they're going to stabilize and hide what's really happening from you. I've been saying for a long time, they're between a rock and a hard place. I hope you can see it now because it's a big rock and it's a big hard place. But don't worry because they'll just do this, right? Discount window borrowings reached all-time high. That's the Fed's backstop, and it way surpassed what it did in 2008. There's 2020. And here's 2023. I don't know. You tell me. This is a banking crisis. It is. And it's been building. And I'm not even going to say that this has not been planned because they need a huge crisis to take us into the new system. The only way to fight deflation is with inflation. It's the only way. Like the only way to fight inflation is with deflation. The only way. Oops. Now let's look at the Fed's balance sheet because I want to show you something here, which I've shown you before. But hey, prior to 2005 and even going into 2008, it was roughly $800 billion. This is when they first thought that they could stop printing, but then no, the markets got addicted to this free money. So, up it goes. Here, this is 2016 when they tried to run off their balance sheet and raise rates. Big freaking fat fail. And then, of course, on steroids, the amount of money that they created going into 2020. And look at where we are right now. They attempted to run off the balance sheet and raise rates. Guess what? Big fat fail. Are they going to raise them 1/4 of a point? Probably, but only because they got to prove that they're in there and they're doing it. But their credibility is shot, except I don't know that it's shot with the public. That's the piece that I'm looking for. That's the piece. But if you think that the Fed's move is going to have a positive impact pushing down inflation, think again, because look at their balance sheet. This is this area right up in here. Trying to lower it, and boom, boom, just print that money. Why? I wish this would happen to them. Why? Because they do not have anything left. And I got to tell you guys, the world is littered with currencies, government-backed currencies that no longer exist because of the same behavior. And it kills me when I see these 30-year-old analysts come out and say, well, this time is different. I am so grateful that I have been groomed for this moment in time. I am so grateful that I was born in 1954 and was a teenager when they shifted to a pure debt-based system because I didn't understand it. But I remember it, and I remember what it tasted like and smelt like and looked like and how it impacted people and the markets and inflation. Uncle Al, thank you. I'm so grateful to my Uncle Al. Every single time they have tried to raise interest rates and reduce their balance sheet because they've gotten the markets addicted to free money. And all of that pushing out on the risk spectrum, all of that accepting zero interest rates, all of those bonds, as they were ramping up the interest rates, the principal value of those bonds declined. They were taking losses. The Fed's taking losses because of how much is on their balance sheet. I mean, look, this is how much garbage is on their balance sheet, and we've been at zero interest rates since here. These are losses. And they said that it doesn't matter because the Fed can just print the money that they need. Guess what? They're not gods. They're human beings. They make mistakes. Boy, do they make mistakes. Their job is to stabilize the financial system? No, it's price stability, which means to keep you stupid. I'm sorry for saying that, but that is their job, so that you move forward in a way that supports their goals. Well, I want you to be smart. I want you to have the ability to make educated decisions and educated choices that put your best interest first. Because what do you have when you have all of this garbage? I mean, if a government says this is money, they can also say it's no longer money. What is that? Right? You're working for this. You're trying to save for your future with this. You're not going to be able to do it, period. And you know what? The only difference between this, and this is actually a real imitation. Oh, here, this is a $100 bill. Okay, this isn't from my money gun. The only difference between these two is that we can use this when we go to the store. At least for now, we can still use cash. Get rid of the cash. Then they got you totally by the cojones. And by the way, even if you have the cash, if you're going to get it out of the system, do it now before they've put the little chips in there, though I can't tell you whether they have or they've not. And that's not all of this is not the only thing that's going on, because we have that LIBOR to SOFR transition upcoming. Now, this is according to all the powers that be, but the LIBOR is supposed to completely disappear June 30th of 2023. Now, what does that mean? That means this is exactly why I've been saying since the beginning of the year that there needed to be a big crisis, because I don't think they can make this transition, and Wall Street doesn't think they can make this transition, but they're forced. So the vast majority of U.S. loan market is comprised of legacy transactions. So remember I said those were the legacy ones that remain tied to the retiring rate. For every U.S. institutional loan already using SOFR, there are approximately 5 deals that still need to be transitioned. And would you say today's the 16th?
21st.
The 21st? I'm working so hard I can't even remember what day it is. But this is the 21st of March, April, May, June. We're a little bit more than 3 months away. Borrowers are also closely scrutinizing the impact of the transition on their all-in loan pricing. This is what I was talking about, because LIBOR is a forward-looking unsecured rate, and it factors in counterparty risk. Any contract is only as good as the counterparty to that contract. Term SOFR is derived from a backward-looking secured rate that does not carry any element of credit risk. So they work differently. They work differently. As a result, term SOFR has historically tracked lower than U.S. dollar LIBOR. This gap has led to the development of the credit spread adjustment and an additional amount of interest that can be added to term SOFR in order to counteract any transfer of value, but it doesn't work fully. They have not been able to figure out a formula to make SOFR trade exactly like LIBOR. And again, I go back to this. So, when interest rates go up, the principal value goes down. When interest rates go down, the principal value goes up. What that means is that it may be only pennies per dollar's worth of contract, but when you go into the many, many trillions, and again, I just showed you, nobody really even knows how many contracts are at risk. These are all, it's not just the debt contracts, it's all of the derivative contracts as well. Nobody has any idea of how much is at risk. And these are the guys that are driving this bus right into a wall, right over a cliff. Are you freaking kidding me? I mean, I'm dead serious about this. This is a tectonic shift. That's why what's happening now had to happen before June. Those lenders may argue the ARRC recommended CSAs are appropriate in light of the historical average difference between, blah, 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 blah. But it has affected borrowers. Many prefer to hold off for now on the transition to term SOFR if it could cause their all-in loan pricing to, boom, increase overnight. Thank you. Has that not been what I've been saying? And you guys have been following me, so you know that is exactly what I've been saying. But let me just kind of show you what the BIS, the Bank for International Settlements, talks about this shift. Okay, let's see. This is the basis risk. So this is how much the interest rate would change. And in the RFR, which is the SOFR, and the LIBOR world, the old basis risks related to LIBOR behave differently. And you can see they went down a little bit, they went up a little bit, but 6 month, and what you're looking at here is the 6 month LIBOR minus. This doesn't matter, but what you need to know in this is the LIBOR only the LIBOR. Now this next one is related to the transition. So it's the LIBOR to the SOFR. And look at what a difference that is. Post-LIBOR basis risks can loom large. That's what I'm talking about, this tectonic shift. It's hiding in plain sight. It's just that people don't ever bother to go and read this stuff. I'm so grateful. I'm so grateful that I have been groomed for this moment in time. You guys have no idea. I say thank you constantly, to be honest with you. To promote the adoption of RFRs, so the SOFR, OTC interest rate derivatives markets have become strongly anchored in reference rates that are overnight and largely insensitive to bank funding costs. See, very, very short term. And we've been watching the 2-year Treasury act like a penny stock with massively wild swings. This could potentially lead to a lack of usable benchmarks that capture term liquidity, permia, and credit risk. Such factors could be important to financial intermediaries active in both borrowing and lending. That means that the banks can't see the danger and the risk and the loss of liquidity. That means all of this money that's been pumped into the system in just the last week, that's what they're talking about. But don't worry. We're operating in an ample reserve regime. There is no reason for the banks to hold reserves or anything else to protect you, the depositor. And the ones that they choose to bail out, they'll bail out. Well, let's just hope that wherever you are is not so small that they choose not to bail you out, because it's not going to cause contagion. But it doesn't even matter, because wherever this starts, you get your contagion. And so, I mean, I've shown you this graph so many times before, but the contagion is already happening. This is not something that's going to happen in the future. It is something that is happening already. And I think it was Hemingway who said, when somebody asked him, how did he go bankrupt? And he said, slow and then fast. When do you want to get prepared? Food, water, energy, security, barterability, wealth preservation, community, and shelter. I hope you've gotten it done. And if you haven't, click that Calendly link below. Get it done. Get as much done as you possibly can. Start right here. Start with a garden so you can feed yourself, but protect your wealth. Because at least if you protect your wealth, you have a shot at buying the rest of the stuff that you need. I mean, I could tell you this too. I've been working really hard to get the bug out location all set up. And we are going up there, so we'll be recording that. Edgar's going too. We're going up there this weekend, and we're bringing a lot of meat and a lot of fish. We are loading up on the freezers that I have up there. I have 2 big freezers and then a regular refrigerator freezer, and I have buckets. I'm going to show you everything. We're gonna go over it, although I'm sure that once Chef Jason gets his hands on it, it'll be organized much better than what I could do. I just really want you to know it's already happening. And what you're looking at here is Exeter's pyramid. It shows all the money and all the assets in the world, and it gives it to you from a risk perspective. As financial risk increases, money tends to move from the more risky assets, derivatives, the most risky, to the least risky assets, to physical cash, and then gold. And gold is the least risky asset. So here's your riskiest and here's your safest, and you can see gold here on the bottom. But let me show you where we're at with this. Because the interesting thing is that the most risky things are all intangible. And so you know what I always say. If you don't hold it, you don't own it. I mean, it truly is just that simple. So they're anticipating a quadrillion in derivatives. But my bet, when they pay 180 trillion to compress it down to 185 trillion, there's way more than 1 quadrillion in there. And actually, before they changed the formulas, I counted out 1.4 quadrillion, and that was probably like 2009-ish, 2008-ish. How many quadrillions are there now? I have no idea. It's hard to even conceptualize a quadrillion dollars. Private business and real estate, 300 trillion. Securitized debt and listed stocks, 116.4 trillion. Government bonds, 56.7 trillion. Bank money, 50 trillion. Now we go to tangibles, which is cash, which can be easily made worthless, okay? But they are tangible, and they do prevent the central banks at this point of going way below zero, right, on their interest rates. So in other words, eating your principal. And then there's the gold. That's it. 166.5 tons of physical gold in the ground, above the ground. That's it. There's a finite amount. There's an infinite amount of all of this garbage because all they have to do is push a button. It's easy to create it. It's cheap to create it. And then they created formulas that even hide what they're doing. So how accurate are any of these numbers? Who the Hades knows? I couldn't tell you. Just be aware. Flight to safety, get here. Get here as quickly as you can. Get here with as much as you can. And you'll thank me. You'll thank me. Make sure, I know, I did part 3 first, and I'm telling you right now, I did it because this information needed to go out. Make sure you watch part 1 and part 2 that's coming out this week. So I kind of did it backwards because it's how they set it up, how they changed the laws even till recently to get everything into place, because you and I are the right size to fail. But I don't want you to fail. I don't want you to fail. Watch last week's Coffee with Lynette interview with Mario and Echo, because we really talked about the first fuse that was lit, which was back in September in the Bank of England. And we launched that new Spanish channel. So make sure to watch it and share, because everybody needs to know what's going on here. How many times can you be lied to when you don't know the truth? That's just not okay with me. I want you to know the truth. And hey, you disagree with me? I'm okay with that. I just want you to make educated choices that put your best interest first, period. And if you haven't done so already, make sure you subscribe, leave comments, give us a thumbs up if you like it. You should give me lots of thumbs up for this one. This is a good one. And share, 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 share. We are running out of time. Financial shields. They're made of metal, not this garbage. Government says it's money. Boop, no longer money. What are you gonna do? This is used in every aspect of the global economy. Share, share, share. And until next we meet, please be safe out there. Bye-bye.